Bank of America anticipating next year will be a stock picker's paradise, with the S&P 500 hitting 5,000 by year end next year, not this year. Joining us right now is Savita Subramanian. She is Bank of America Securities head of U.S. equity and quantitative strategy. And look, there are a lot of people who are now starting to question that, hey, we've run a long way in November. Maybe we're going to see a pullback on some of these things. You think you're pretty convinced that things are going to go up from here?
I mean, not in a straight line. I think there is a high probability of, pullbacks next year around various areas of concern. But I do think that we're in a healthier market setup than we've been in a very long time. So I'm actually feeling pretty good about the market. I mean, if you think about it, it's not even what the Fed, we're not bullish because of what we think the Fed is going to do.
In terms of, you don't expect any pullbacks in rates?
We don't necessarily have a view that's predicated on a big drop in rates. It's really more about what the Fed's already done, which is, the Fed has done a lot of the painful work already, and chances are it's close to over. The market has handled it so far. Sure, there are lagged effects of monetary policy, but if you look at consumers and corporates, I think whenever we say, when we look at things like delinquencies and worry about the fact that they're rising, they're actually just coming back to more normal levels from pre-COVID lows. So I think that we're in an environment where the U.S. consumer and corporates actually look pretty healthy. Consumer confidence might be a little bit rattled by the fact that rates have moved higher, but the bulk of consumers have been able to withstand this pressure. And where we're seeing the pain is more in millennials, which are the prime spending group. But I think even there, the bull case that I don't think gets a lot of airtime is the fact that baby boomers are right at the cusp of this massive wealth transfer. So if you look at the average age of a baby boomer, it's the average lifespan of a human being. Grim statistic. But what that means is that we are at the beginnings of this sort of wealth transfer from, the wealthier generation that's sitting on $80 trillion worth of assets to the more strapped millennial generation.
Wait, they're all going to die and give their money to the youngsters?
Well, okay. So, one way of saying it is, we're at that point where that wealth transfer begins. But then on top of that, I think there's also the idea that baby boomers are even spending more on services and goods than they used to. So it's not just baby boomers are taking over all the wealth and they're never going to spend again. I think that there are cross currents that are actually pretty bullish for consumption. So in the U.S., I think that U.S. consumers are actually in a pretty good position.
We have never seen the Fed raise rates by 500 basis points and have it not result in some pretty severe dislocations. Why do you think this time is different?
So I think this time is different for a number of reasons. One is that we were at almost too accommodative rates at the beginning. We were at 0, and going from 0 to 5 is different from going from 3 to 8. So I think the fact that we were going from super ultra too accommodative to more normal is one facet of this. I think also on top of that, you had consumers and corporates preparing for a rising interest rate environment, and in fact they locked in long-dated fixed-rate debt obligations at very low interest rates, and I think that's serving them well now. I'm not saying it's going to be gravy from here, but I do think that the one kind of positive where we are today versus where we were a couple of years ago is we know how the Fed is going to get off of ground zero in terms of interest rates. We're already past that point. We've seen massive inflation volatility, and inflation volatility, we know inflation isn't going to be 0. It's not going to be 10, but it's going to be somewhere in between that range. And on top of all of this, we also have an environment where U.S. companies have begun that process of moving IP, tech, equipment out of China and less friendly regions of the world back to the U.S. So I almost feel like a lot of the work is behind us rather than ahead of us, and now we can kind of get a better grasp on what earnings are going to look like.
We were 4,800 in 2021.
We were.
So your big bullish case gets us to 5,000 by the end of 2024. So 3 years later, we have a total S&P return of
not that much.
3 or 4%.
Exactly.
That's not. I mean,
what's surprising?
That's not a very crazy call.
It's not a crazy call,
but it's also only 10% next year.
It's 10% returns next year, which is a
couldn't we do 20?
Above average. I mean, I think we could do 20. It depends on the shape of the consumer. It depends on confidence. But I think the idea is we're, one of the higher forecasts on Wall Street, and we're not that aggressive. I think most strategists are quite bearish at this point.
That's a really
conservatively allocated.
Most people have not experienced what you're looking at right there since 1980. It's been almost straight up since 1982, basically. I mean, this has been, what would you call that? A secular trading range? I guess it's really kind of a secular...
It's a big, fat trading range. Yeah. But I think, and maybe we stay in it.
It's only over a couple of years. It's not over.
Yeah. I mean, it's kind
10 years, which would be the scarier.
Could be. It could be. You have to start with 2.
Yeah. I don't think it's going to be a trading range for the next 10 years. I'm bullish on equities for the next 10 years.
About $34 trillion in debt.
Okay, that's government debt, right? And government debt is not anathema for U.S. stocks. Even if we're an emerging economy now and, we're going to be downgraded.
Higher interest rates could be anathema and that's what results from the $34 trillion in debt.
But the higher interest rates, I mean, what's interesting is that the higher interest rates are going to hit a lot of pockets of the economy, not necessarily public equities, because public equities have been marked for this environment. What I worry more about is all the stuff sloshing around in private equity, private credit, the shadow lending machine that's been taking place for the last 10, 15 years. But public equity right now is marked to exactly what's happened. And that is a high interest rate environment. We all know what refinancing risks are going to look like. Unless rates double from here.
But I can connect some dots for you between when the government owes that much, they have no money to spend it on anything else that they want to spend it on. And you know what they do? They don't spend less. They try to take more in. So they're going to raise taxes. They're going to raise taxes on corporations. They're going to raise taxes on individuals. None of that is good for stocks.
I don't necessarily see that happening in the near term. I mean, I think that one of the ways the government has been able to navigate high deficits is by outgrowing that deficit. And I think that the U.S. economy is actually at a good point at which we could see tremendous surprises in GDP growth going forward. I mean, think about it. We're at a point where we have had underspend on manufacturing. We have the best technology.
Maybe AI.
AI could be part of this productivity boom. I mean, we haven't really seen a productivity boom in a very long time. We've mostly seen earnings from cheap capital globalization. Now we're at a point where we could actually see productivity kick in, efficiency gains. I hear the music. I know you want to kick me off.
You know how that works. You know how that works.
The most bullish part of our call is this productivity story, which I think is a great theme for the U.S.